Good morning. You are watching live daily market outlook for Monday, 7th of May 2012. A lot of action seen in the markets recently, with most of the riskier assets slumping after the disappointing US jobs data last Friday, and the more significant elections in France and Greece that brought some rather unexpected results that pushed the markets, especially the single currency as well as commodities, significantly lower. The Greek voters dealt a serious blow yesterday to the fragile political consensus that has kept Europe's currency bloc intact through more than 2 years of crisis, rejecting the austerity for aid policies that have shielded the country from bankruptcy and the exit of euro currency. Greece's vote, combined with the victory of socialist François Hollande over incumbent Nicolas Sarkozy in a French presidential election, will raise pressure on Europe's paymaster Germany to pursue a more growth-oriented approach to the crisis. But it is far from clear whether Chancellor Angela Merkel, whose insistence on tough deficit reduction in vulnerable southern euro members is popular in Germany, will take more than symbolic steps in that direction, even after Sunday's elections. The comments from analysts say that this shows actually that politics is getting out of control in Europe, and the gap between politicians and voters is widening. That's what we see now in Greece, and that's what we will see in France. Also, clearly the voters across Europe have started to send a message: we are not ready to do the reforms, and that's worrying. More immediately, the struggle of Greece's two big pro-bailout parties, Conservative New Democracy and Socialist PASOK, to secure a parliamentary majority, raises questions about whether Athens can stay in the Eurozone in the long run, and may spark a new wave of contagion to other member states. The Greek result puts Hollande, new president, on the international stage, who has never held a ministerial post, not even met Merkel, in the hot seat from day one. Investors worried about Greece's future and the arrival of the first socialist in the in France in 17 years could punish European financial markets starting on Monday, pushing the entire bloc back towards crisis mode. Hollande must cobble together with the government rapidly and prove that France, which alongside Germany has led Europe's response to the crisis, is capable of taking the quick decisions needed to keep the 13-year-old currency zone together. Perhaps the most crucial questions in Europe over the coming days is whether markets spooked by elections renew their attacks on a big Eurozone state like Spain, which has pressed ahead with the deep budget cuts and economic reforms in a desperate bid to win back the confidence of investors. Both Spain and Italy are considered too big to fail and would severely test Europeans' resources if they require the kind of bailouts Europe has already given to Greece, Ireland and Portugal. The European Central Bank, in a further step, has made a massive amount of liquidity available to vulnerable banks, a move which calmed markets in the first months of 2012, before concerns about Spain's dire economic states resurfaced. However, both Greece and Spain have endured the austerity that has pushed their unemployment rates close to 25% and led to severe contraction in economic activity. Pensions have been slashed and public sector workers fired and taxes hiked. Hollande's campaign was predicated on a new approach to the crisis that would put the growth first. As the first steps, he is expected to travel to Berlin as soon as he is sworn in to begin negotiations on the new growth pact for Europe that would complement Merkel's fiscal compact, a set of rules to ensure German-style budget discipline across the Eurozone. New measures to bolster growth are expected to include steps to increase the firepower of the European Investment Bank, make more flexible use of EU structural aid funds and so-called project bonds to fund investments in infrastructure projects like highways, bridges and energy and networks. The Franco-German deal could be rubber-stamped at the summit of EU leaders in Brussels in late June, but few economists believe the pact will make much of difference for countries on Europe's hard-hit southern periphery. This is going to be our focus in the coming days for sure. Just to mention that Euro continues to travel south with the overnight gap lower opening, now testing the lower side of the strong support band at 130 and 129.50, with 129.50 been hit already during the night, keeping the strong pressure on the single currency against US dollar, with the British pound also following a euro extending losses down towards 161 zone. Dollar against Japanese yen remains also under pressure after a failure to extend the recovery of previous low at 79.63. That was blocked, capped at 80.60 zone, with the fresh losses retesting 79.63 and marking the full retracement of the short-term recovery attempt that opens way for a further extension lower. From the other side, dollar remains firm against Swiss franc as the latest rally of during the last week from 90.41 and especially that last Friday's push higher and overnight's gap higher opening broke above our initial barrier and strong resistance at 92.50. That might open way for test of next key barriers at 93 zone. Gold remains under pressure but hovering around the 1630, 1640 zone after bounce of last week's low at 1626 and some boost given on Friday's rally on US data was quite short-lived, with the gold also having a gap lower opening during the night, keeping the downside firmly in focus so far. The main loser of last week, registering the biggest weekly losses since November 2011, was crude oil that sharply dipped off last week's peaks at above $106 per barrel. That accelerated losses last Friday after a release of US jobs data, losing all significant supports, even breaking below $100 per barrel. That was our key psychological level on the downside, extending losses so far to 95.33 for the contract of NYMEX June crude oil. Negative tone continues to dominate on the crude oil's technical outlook, with some corrective action not ruled out at this point, as most of the studies are quite extended towards the downside. More of this will be seen on our technical part that will follow shortly. Meantime, we're going to take a look on the calendar for today's events and see what are the events due to be released today. So, as already have some results during the overnight session from Australia, building approvals monthly for March came in much better way than expected. 3.2% was forecast, with the building approvals release coming at 7.4% versus the previous release of February at minus 7.8%. Australian retail sales also are picking up. 0.9% is March release compared to 0.3% forecast, and 0.2% of month of February. Australian business confidence also is higher. Today's release reading is 4 compared to the previous one of March at 3. UK is closed today for a holiday, while from Switzerland unemployment rate came at expected level at 3.1% lower than the March's release at 3.2%, with the foreign currency reserves of Switzerland for May decreasing to 235.6 billion Swiss francs compared to April's reserves at 237.5 billion Swiss francs. Swiss CPI came at minus 1% on a yearly basis compared to the forecast of minus 0.9%, while monthly release is plus 0.1% compared to forecast of 0.3%, and release of March at 0.6%. So decrease in the inflation in Switzerland. From Eurozone, 8:30 GMT is the Eurozone Celtics investors' confidence that is forecasted for slight improve. Minus 14.3 is today's consensus compared to minus 14.7 of the month of March. Germany's factory orders for March are due at 10 o'clock GMT. Also slight improvement seen for today, raised by 0.5% compared to 0.3% of February. While across the ocean, Canada starts at 12:30 GMT with the monthly building permits for March. Sharp decrease from the previous release at 7.5% is seen for today's release at 2.3%. U.S. consumer credit is due at 1900 GMT for March, and no forecast. 8.7 billion was the release of month of February. Now we're going to take a look on the currencies and the commodities and see the latest movements. As said, euro against dollar is in a steep decline of last week's high at 132.82, where the gains of a previous low at 129.93 were rejected, with the three-legged decline hitting a level at 129.53. This was the overnight's low after gap lower opening last night. Some consolidation was seen in the mid last week, holding above 131.00, and that kept basically some hopes of a possible higher low and further recoveries. But last Friday's action after release of quite disappointing non-farm payrolls data pushed the single currency significantly lower, with loss of initial support at 131.00 and also Fibonacci level, extending losses as said so far to 129.55. Better seen on the daily chart, where the pair basically broke below longer term consolidation range that was supported on the downside by 130.00, 129.73, and Fibonacci support at 129.52 that has so far been tested. 61.8% retracement of the yearly rally from the yearly low at 126.22 of mid-January to 134.85 and the February peak. This keeps now the focus on the downside, as the recent recovery rally was capped by a trend line, main bear trend line of 134.85 through 133.80, with loss of the base at 130.129.50 expected to further to accelerate losses and open way towards 129.00 and around figure support, and 128.75 low of 23rd of January, also 2012, also low of 9th of January 2011. This is now acting as very strong support along with 129.00. On the upside, immediate barrier comes on today's opening high at 130.30 as the pair regained 130.00 handle, with the possibility quite low of filling the gap, regaining 130.80 and 131.00 levels that are for now expected to limit the upside. Only break above barriers at 131.55, 55 days exponential moving average, and last week's double top at 131.80 would significantly improve the outlook and avert immediate downside risk. Otherwise, current structure with negative studies keeps the downside under heavy pressure, although the situation on the hourly chart shows most of the indicators in their extreme points, as the RSI is already emerging out of oversold zone. But this move higher is so far seen corrective, and a number of obstacles are threatening to cap the recovery attempts. As said, only break above 131.80 zone, double top of last week, would provide the near-term relief. Otherwise, the focus remains at the downside. Along with the euro, the sterling is also in the short-term down move, correcting the recent strong rally of 158 zone that peaked at 163.00, and since then the pair is in the corrective pullback. Extension of losses through the previous week's consolidation floor at 161.60, where also 55 days exponential moving average limited the downside. However, the upside was capped by descending 20 days exponential moving average with break below 161.60, extending losses so far to Fibonacci 38.2% retracement at 161.15, retracement of the entire rally from 158.17 to 163.00, and keep the focus at the downside as near-term studies maintain the negative tone. Some corrective action is seen this nearly hours of Europe as hourly studies reached their came close to the oversold territory, but this is so far seen corrective with the strong barrier at 161.60 previous support now acting as stronger resistance along with the 55 days exponential moving average, and the descending 20 days moving average that is looking now for a bearish crossing below 55 days one that will confirm the negative tone and open way for a further extension higher. For now, the 162.00, 162.15 acts as a very strong barrier, and basically only break above this level would avert immediate downside risk. On the downside, loss of days low at 161.13 opens 161.00, and more significant break point at 160.80, that is higher platform of end of April, as well as previous peak of 160.61 of beginning of April. And this is basically the break point for sterling. Break of below this level would open way for more significant losses, with the 160.00 coming next as a round figure support, and Fibonacci 61.8% retracement of 158.17 to 163.00 rally. The dollar yen is also ran out actually of steam last week after recovery attempt of 79.63, 1st of May low failed to clear 80.60 zone. The gains were capped initially at 80.60 and 80.54 with the lower top at 80.39, defining the descending mode, and the overnight action dipping back to 79.63 exactly. That marks a full retracement of the near-term recovery attempt, and keeps the focus firmly lower. The 55 days exponential moving average capped the upside action ahead of trend line, descending trend line of 84.08 peak, currently at 80.64, that keeps the upside protected for now. Loss of 79.3 is expected as the pair dented also 90 days moving average shown on the daily chart, is expected to extend the reversal of 84.17, 84.08 yearly peaks towards the next Fibonacci support at 79.13, 61.8% retracement ahead of 79.00 that marks round figure support, and the high of 1st of November 2011 that will be seen on a break below 79.63 and 79.52, which is end of October 2011 post-intervention peak. A loss of 79 handle would definitely confirm the top at 84.17, and look for test of 78.37 200 days moving average, and that will be possibly a signal of further retracement of the strong rally from the beginning of February from 76.00 base that peaked at 84.17, so far high of year 2012. The dollar Swiss remains in the strong ascending mode after finding support at 90.41, just below 90.50 higher base, and a strong extension higher during the last week with gap higher opening seen today, clearing our initial barrier at 92.50. So far we have seen 92.69 high that was posted shortly after opening. This turns the short-term structure more positive, as daily studies are now breaking above their midlines and looking for a further extension higher, as initial barrier at 92.50 has been regained. This keeps also the downside protected at 90.41, ahead of more significant supports at 90.00 and 89.30. Further extension higher, fair break above 92.50 is to focus. That is also marking 50% retracement of the descent from a yearly peak at 95.93 that bottomed at 89.30, above which is to open more significant barriers at 93.00, also peak of 16th of February, as well as around figure resistance, and static support, static resistance at 93.33, highs of 14th and 15th of March 2012, also marking the short, medium-term range, top range of beginning of February 2012. As the downside remains protected, the focus is still at the upside, and the likely scenario is the retest of our upside targets at 93.00 and the 93.30 zone. Near-term studies are at their extreme points, and possible correction now is not ruled out at this point, with the days low at 92.13 and 92.00 as round figure support, seen as initial support, with the last week's close at 91.80 zone that will mark cover of the recent gap, expected actually to hold the downside protected these levels and keep immediate bullish structure of last week's low at 90.41 in play for a possible extension higher. For now, only break below 55 days moving average, currently at 91.30, and a higher platform at 91.13 would significantly damage the current bullish structure and turn the focus lower towards 90.41. Until then, ideally reversal should be seen around the 92 zone in order to keep the short-term bulls in play for test of 93.00 and then 93.30, our next key barriers and the targets on the upside. As mentioned, crude oil is the biggest weekly loser of the last week, as a steep decline shown from on the daily chart shows the oil price significantly losing its value. This is based mainly on the fears after negative data release from Europe and America, increased fear of investors for a lower demand for the energies of the major world economies that triggered initial reversal that accelerated basically on Friday's release of U.S. jobs data, and further extended the overnight on disappointing, for the market rather disappointing news from Greece and France that actually, I would not say disappointing, but markets and investors became more concerned now about the futures of the markets, especially the commodities. That triggered actually slump of the oil price initially through 100.67. That was our initial static support, and $100 per barrel. That was this strong psychological support. Also denting 200 days moving average at 96.35, extending so far to 95.33. This is just actually the previous low at 2nd of February 2012 at 95.43 has briefly been dented, and this keeps firmly the downside in focus. Negative tone dominates on the larger time frames such as daily chart, while short-term studies are in their extreme levels overextended, and some corrective action is seen at this point to recover the recent losses. Immediate resistance now comes at I would say strong one at $100 per barrel and 100.67, and I would say these two levels are ideally expected would be ideal if losses if recovery is capped at this point. However, further up is 101 and 102 zone that is coming next. Negative sentiment for in the markets, especially regarding energies, keeps the pressure on the on the oil's price, and the likely scenario would be some recovery, a lower top and further extension lower, with the next significant support below 95.30 zone would be at 92.70 low of 16th of December 2012. That was all for today. We're back tomorrow morning at the same time at 7:00 GMT. For all those that connected later or missed any part, you will be able to find shortly after we end our session the recorded version at Windsor Brokers page in YouTube called Windsor Brokers Forex. I wish you a nice day and very successful trading, and we are back tomorrow morning. Thank you.